Chapter 1. The Canyon. Why you can't own anything anymore. 0:45 to 3 o'clock. B-roll visual suggestion. Split screen chart, wage growth line, flat, slow rising, versus home price line, steep, exponential. Since 1980. Let's start with the uncomfortable truth. There is a canyon forming in the modern economy. On one side, you have wages, the money you actually take home. That side of the canyon has barely grown. On the other side, you have asset prices, homes, land, even the software subscriptions running your business. That side is a skyscraper, and it just keeps getting taller. Here's the question I want you to sit with for a second. Asterisk, if you were graduating college today with the same salary your parents had, but home prices had tripled, would you still believe hard work and saving is a winning strategy? Asterisk. B-roll visual suggestion. Animated graphic of a stick figure trying to jump across a widening canyon gap, falling short each time. Because here's what's actually happening behind the scenes. Since around 2012, institutional investors, hedge funds, private equity giants, and massive real estate investment trusts have been buying single-family homes in bulk. Not one house at a time like a normal family. Entire neighborhoods at a time. Cash offers, no inspection contingencies, no mortgage approval delays. They can move faster than you, and they have effectively infinite capital, and it's not just houses. The same playbook is happening with data centers, that power the cloud you rent every time you use software. Cell towers, that every phone company has to lease space on. Storage units, parking garages and warehouses, the invisible infrastructure of modern life. Farmland, Yes, even the dirt your food grows in is being bought up by institutions. B-roll visual suggestion. World map graphic with pins dropping across the US representing institutional real estate purchases, accelerating in speed. Think about that for a second. What would it mean for your financial future if you never owned a home, but instead owned a small piece of every company that owns homes? That's not a rhetorical trick. That's a completely legitimate, publicly available investment strategy, and we're about to break down exactly how it works. CTA number 1 subscribe. Timestamp, approximately 3 o'clock. B-roll visual suggestion. Subscribe button animation pops up bottom right corner. Quick pause. If this is the kind of financial analysis that actually makes you think differently about money, hit subscribe right now. We break down exactly how institutional capital moves before the average investor catches on, and you don't want to miss the next one. Alright, let's get into the actual mechanics. Chapter 2. The corporate rental machine, explained, 3 o'clock to 6 o'clock. B-roll visual suggestion. Animated diagram. A giant funnel labeled REIT, collecting rent checks from hundreds of small house icons, then distributing dividend checks out to investor icons. So how do you actually own a piece of this machine? The answer is a structure that's existed since 1960, but is exploding in relevance right now. The REIT Real Estate Investment Trust. Here's the simplest way to think about it. Imagine you and 10,000 strangers all pooled your money together to buy an apartment complex. None of you individually could afford it. But together, you can. And now all 10,000 of you split the rent checks every single month. That's a REIT. By law, REITs are required to pay out at least 90% of their taxable income as dividends to shareholders. That's not a marketing gimmick, that's the tax code. B-roll visual suggestion. Simple animated pie chart showing 90% of profits must go to shareholders with a government building icon labeled IRS. Now here's where it gets interesting. There isn't just one type of REIT. There's an entire ecosystem, and each one owns a different slice of the things you can't afford pie. Residential REITs These own thousands of single-family rental homes and apartment complexes. Companies like Invitation Homes and American Homes for Rent literally became the landlord for entire suburban blocks after the 2008 crash. Data center REITs Companies like Equinix and Digital Realty own the physical buildings where the cloud actually lives. Every time you stream a video, save a file, or use an AI tool, you're renting server space from one of these companies, whether you realize it or not. B-roll visual suggestion. Cutaway shot of a data center, rows of blinking server racks. Cool blue lighting, asterisk asterisk cell tower, REITs, asterisk asterisk. American Tower and Crown Castle own the physical towers that every major carrier has to lease space on. It doesn't matter if you use Verizon, AT&T, or T-Mobile, there's a good chance you're paying one of these companies indirectly. Asterisk asterisk industrial and logistics REITs asterisk asterisk. Asterisk Prologis owns massive warehouses that companies like Amazon lease to get your packages to your door in 2 days. Here's a question for you. Asterisk asterisk. Which of these 4 categories do you personally interact with the most in a single day? Your phone, your streaming, your Amazon delivery, or your rent? Asterisk asterisk. B-roll, visual suggestion. On-screen graphic, a day in the life. Clock showing touch points with each REIT category throughout a 24-hour day. The genius of this model is that you don't need $400,000 for a down payment. You can buy a share of some of these REITs for less than the price of a nice dinner. The barrier to entry that locks you out of physical real estate simply doesn't exist here. Chapter 3. Real case studies. The company's already doing this. 6 o'clock to 8 o'clock. Buy roll visual suggestion. Logo reveal animations for each company mentioned, styled like a stock watch list app. Let's make this concrete with real numbers, because theory is nice, but you're here for specifics. Asterisk asterisk Invitation Homes, ticker INVH, asterisk asterisk. This company owns and rents out over 80,000 single-family homes across the United States. It was literally built out of the wreckage of the 2008 housing crash, when private equity firms scooped up foreclosed homes at pennies on the dollar. Today it's a multi-billion-dollar public company, and anyone can buy a share of it. Asterisk asterisk American Tower, ticker AMT asterisk asterisk, owns over 220,000 communication sites globally. Every single one of those generates recurring lease revenue from telecom companies who have no choice but to pay up, because building your own tower network from scratch would cost billions. Burrell visual suggestion, split screen cell tower on the left, server room on the right, both with animated dollar signs flowing outward to a shareholder icon. Asterisk asterisk Equinix, ticker EQIX. Asterisk asterisk. This one's fascinating because most people have never heard of it. Yet it's one of the largest data center operators on Earth. It doesn't build the apps you use. It just owns the real estate those apps physically run on. It gets paid whether Netflix has a hit show or a flop, whether the stock market is up or down. Here's the pattern I want you to notice. Asterisk asterisk. None of these companies need you to succeed personally in order to make money. They get paid because you need shelter, you need connectivity, and you need the cloud, regardless of what's happening in your individual life. Asterisk asterisk. That's a fundamentally different risk profile than a regular stock that depends on consumer mood or trend cycles. This is closer to owning a toll booth on a highway everyone has to drive on. Asterisk asterisk. What would change about how you invest if you stopped chasing hype stocks and started asking, what does literally everyone need no matter what happens in the economy? Asterisk asterisk. That question alone is worth pausing the video and thinking about. CTA number 2. Like the video timestamp. Approximately 8 o'clock. Burrell visual suggestion. Thumbs up animation with subtle sound effect. If your brain just lit up a little thinking about toll booth investing, do me a favor and hit that like button. It genuinely helps this channel reach more people who are tired of feeling priced out of everything. Let's keep going because there's a second half of this story that most investors completely ignore. Chapter 4. The software side, you don't own that either. 8 o'clock to 11 o'clock. Burrell visual suggestion. Screen recording montage. Subscription renewal notifications stacking up. Streaming, software, cloud storage, even car features. Now let's zoom out from housing, because the exact same playbook is happening with software, and honestly, it might be even more aggressive. Think about how many things you used to asterisk buy once asterisk that you now asterisk rent forever asterisk. Microsoft Office used to be a one-time purchase. Now it's Microsoft 365, a subscription. Adobe Photoshop used to be a box on a shelf. Now it's a monthly fee that never ends. Even some car manufacturers have experimented with subscription fees for features like heated seats, hardware you already paid for, locked behind software. Burrell visual suggestion. Timeline graphic 2005. Buy once icon transitioning to 2025 pay forever subscription icon. Here's the uncomfortable question. Asterisk asterisk. When was the last time you actually owned a piece of software outright? instead of renting access to it? Asterisk, asterisk. For most people watching this, the honest answer is, I can't remember. But here's the pivot. The same logic that applies to real estate applies here. If you can't beat the subscription model, you can own the companies charging the subscription. This is where cloud infrastructure and enterprise software companies come in. Companies like Microsoft, Adobe, and Salesforce don't just sell software. They've engineered what's called asterisk, asterisk, recurring revenue asterisk, asterisk. It's the business equivalent of owning an apartment building, except instead of collecting rent on a house, they're collecting rent on the tools that run millions of businesses. And once a company builds its entire operation around a piece of software, switching away from it becomes incredibly expensive and disruptive. That's called asterisk, asterisk, switching cost asterisk, asterisk, and it's one of the most powerful economic moats in existence. Barole visual suggestion. Animated moat graphic around a castle labeled with a generic software logo, arrows trying to leave and bouncing back. Cloud infrastructure providers take this even further. When a company builds its entire product on a cloud platform, migrating away isn't a weekend project. It can take years and cost millions. So once you're in, you tend to stay in, and the company collecting your monthly cloud bill knows it. Asterisk, asterisk. Here's a thought experiment for you. If every business on Earth is becoming more dependent on subscriptions, not less, which side of that transaction would you rather be on? The one paying every month or the one collecting? Asterisk, asterisk. That's really the entire thesis of this video in one sentence. Chapter 5. How to actually build this portfolio. 11 o'clock to 13 o'clock. B-roll visual suggestion. Screen recording of a sample brokerage app portfolio screen, mocked up or blurred for compliance, showing diversified sector allocation. Okay, so how do you actually put this into practice without needing to become a real estate mogul or a tech billionaire? There are generally 3 approaches, ranging from simple to advanced. Asterisk, asterisk, option 1. Broad REIT and tech ETFs. Asterisk, asterisk, if you want instant diversification without picking individual companies. Real estate-focused ETFs and technology-focused ETFs let you own dozens of these toll booth companies in a single purchase. This is the lowest effort, lowest stress option, and it's honestly where most beginners should start. Asterisk, asterisk, option 2. Individual REIT selection. Asterisk, asterisk, if you want more control. You can research and select specific REITs across the categories we covered: residential, data center, cell tower, industrial, to build your own custom ownership machine that mirrors exactly the kind of assets being bought up around you. B-roll visual suggestion. Simple bar chart animation showing a sample diversified allocation. 40%. Residential REITs, 25% data center REITs, 20% infrastructure REITs, 15% enterprise software. Asterisk, asterisk, option 3. The barbell approach. Asterisk, asterisk. Some investors combine both, REITs for the physical you'll rent forever side of the economy, and enterprise software or cloud infrastructure names for the digital you'll subscribe forever side. Together, that combination captures both halves of the ownership shift we've been talking about this entire video. Asterisk, asterisk. Quick gut check. If you had to allocate a hypothetical $10,000 across these 3 options right now, which one would you lean toward and why? Drop your answer in the comments. I genuinely want to see how differently people think about this once they understand the mechanics. Now, I have to be responsible here for a second because this isn't financial advice, it's education. REITs come with their own risks. Interest rate sensitivity, sector concentration, and management quality all matter enormously. A REIT is only as good as the properties and leases behind it. Do your own research, understand what you're buying, and consider talking to a licensed financial advisor before making any moves. This video is about understanding the asterisk structure asterisk of the game, not a stock pick. Chapter 6. The counter-argument. What could go wrong? 13 o'clock to 14:15. B-roll visual suggestion. Red warning style graphic overlay. Interest rate chart ticking upward. Now, to be fair and balanced, let's talk about the risk side of this thesis because no investment strategy is bulletproof. REITs are sensitive to interest rates. When rates rise, borrowing costs for these companies rise too, and their dividend yields have to compete with safer options like treasury bonds. That can pressure REIT prices, sometimes significantly, even if the underlying real estate is performing fine. There's also a regulatory risk worth watching. As institutional home buying has become a bigger political talking point, there's ongoing public debate about whether governments should limit corporate ownership of single-family homes. Asterisk, asterisk. Do you think lawmakers will eventually step in and restrict institutional home buying, or is this trend too large to reverse at this point? Asterisk, asterisk, that's genuinely an open question, and reasonable people disagree on it. And finally, concentration risk is real. Just like you wouldn't put your entire portfolio into one stock, you shouldn't put your entire portfolio into one sector, no matter how compelling the toll booth story sounds. Diversification still matters, even within a thesis you believe in strongly. Closing, final CTA, 14:15 to 15 o'clock. B-roll visual suggestion. Slow zoom out from a city skyline at golden hour, skyscrapers catching the light. So here's the bottom line. The old rulebook said, work hard, save up, and eventually you'll own a home outright. That rulebook is being rewritten in real time by institutions with more capital and more speed than any individual could ever compete with. But you now know the loophole. You don't have to win the bidding war against a hedge fund for a house. You don't have to out-negotiate a software giant for ownership of your tools. You can simply own a piece of the machine that's doing the buying. Asterisk, asterisk. So here's my last question for you. Now that you know how this works, are you going to keep renting from the system, or are you going to start owning a piece of it? Asterisk, asterisk, buy roll visual suggestion. End screen with 2 subscribe-related video boxes. Channel logo bottom center. If this video changed the way you think about ownership even a little bit, do me one favor, share it with one friend who's frustrated about housing prices or sick of subscription fees. That's genuinely the best way to help this channel grow, and it might help someone else see a path forward too. Thanks for watching. I'll see you in the next one.